Mark Douglas, Best Trading Psychology Tips, Trading Without Fear. This is a trading skill. It is the primary skill that you will have to acquire to create consistency. Learning how to trade without fear is a function of learning how to think in probabilities. Move from thinking from a trade, by trade mentality, and move to a series of trades perspective. You don't have to know what's going to happen next on a trade. By trade basis to win or make consistent money. When you win, you weren't right, and when you lose, you weren't wrong. It's just a numbers game based on the odds. All price movement has to be the result of an imbalance of a degree of conviction between the traders who believe the prices are going up and those who believe it's going down. There's absolutely nothing to think about. Just put the trade on. No one trade has any more or any less significance than the other. Stay focused on the process of trading as opposed to the outcome. The market was different because I wasn't afraid anymore. That relatively carefree state of mind allowed me to flow in and out of my trades with an easy and effortlessness that I would not have been able to imagine beforehand. Everything you do wrong as a trader is going to be a result of what you're afraid of and the effects that fear has on your perception of market information. Every moment in the market is genuinely and truly unique. If I'm going to trade my methodology appropriately, it really obligates me to take every single trade. I can't be picking and choosing my trades based on what I think is going to happen. The consistency you seek is in your mind, not in the markets. All technical indicators and price patterns do is get you in a situation where there's a likelihood that when you get into that trade, it'll work. By truly accepting that the outcome of this trade can be different than whatever happened the last time, you're positively managing your expectations. When you disconnect, you won't perceive market information as threatening. You'll eliminate the potential to make a trading error, and you'll be aspiring to trade without fear. When you achieve complete acceptance of the uncertainty of each edge and the uniqueness of each moment, your frustration with trading will end. No man ever reached to excellence in any one art or profession without having passed through the slow and painful process of study and preparation. Good market analysis can certainly contribute to and play a supporting role in one's success, but it doesn't deserve the attention and importance most traders mistakenly attach to it. You can't put an extraordinary amount of significance on each individual trade. The best traders aren't afraid. When you genuinely accept the risks, you will be at peace with any outcome. The fact is that if traders really believed that anything could happen at any time, there would be considerably fewer losers and more consistent winners. When you operate from the assumption that more or better analysis will create consistency, you will be driven to gather as many market variables as possible into your arsenal of trading tools. But what happens then? You are still disappointed and betrayed by the markets time and again because of something you didn't see or give enough consideration to. It will feel like you can't trust the markets, but the reality is you can't trust yourself. I define random trading as poorly planned trades or trades that are not planned at all. It is an unorganized approach that takes into consideration an unlimited set of market variables which do not allow you to find out what works on a consistent basis and what does not. However, market analysis is not the path to consistent results. It will not solve the trading problems created by lack of confidence, lack of discipline, or improper focus. When I put on a trade, all I expect is that something will happen. If your goal is to trade like a professional and be a consistent winner, then you must start from the premise that the solutions are in your mind and not in the market. If you want to change your variables at the end of a sample size, you're free to do it. You cannot do it in the middle of one. Change is a function of desire. I'm willing to risk a certain amount of distance from my entry point to find out.